ADC is a better REIT than Realty Income. In this episode, we're going to explain why. We're also going to take you through our valuation model, getting to our intrinsic value, what we believe the acceptable buy price to be for Agree Realty Corporation. And as always, we're going to take a look at the income statements, look at their top line revenue, their bottom line net income growth. We'll look at the health of their balance sheet, their total cash versus their total debt. We'll look at how well they've performed against some well-known competitors. We'll look at their dividend safety, some very important financial metrics, and we'll also see what are the institutions doing, whether or not they're buying or selling. So jumping straight in, it is a REIT. It is down 17%, which is a common theme with REITs this year. It is trading towards the mid to lower point of the 52-week range, and it does offer a yield of just over 5%. Now, if you have been holding this over the last 10 years, well, you would be up around 111%. It doesn't include those dividends reinvested, but still a healthy return on investment. And we can see its all-time high just before that COVID crash at just shy of $80. Now, let's take a look at their income statement and what we aim for on the top line. 5 to 10% growth for REITs, 137 million reported in December 2018. 430 million reported in December 22. So some very strong growth over the last 5 years. On top of that, the trailing 12 months is showing 510 million. So it looks to be that their December 23 report will show signs again of some very healthy increases. And do subscribe and hit the bell button so you are notified when we do release our annual report analysis on ADC. On top of that, we do see healthy increases year on year on their top line, and we'll analyse shortly the last 10 years in percentage form. Bottom line, what story can we see? Well, 58 million reported in December 2018, 152 million in 2022, and again the trading 12 months is showing us signs of a healthy increase. When we look on a more granular level, again increases year on year, so very, very healthy in terms of their income statement. Now we draw our attention to the health of the company, their balance sheet, total cash versus total debt. 54 million of cash in 2018, 6 million in their latest quarterly report. So when we do take a look at how that compares numerically and directionally to their total debt, we see it has gone from 722 million in 2018 to 2.2 billion from their latest report, which shows that this has increased 3 times whilst their cash has dropped quite a lot. And we will touch upon that and discuss that when looking at their dividend safety. Now, comparing them to some REITs in the essential retail REITs industry, we have Spirit Realty, Brixmor Property, Kite, Triple N, Realty Income. Now, year to date, what we can see, ADC is down around 13%, one of the worst performing in the industry. We see Realty Income down 11%, so slightly better performing. When we extend that to the last 5 years, we actually see ADC as one of the middle of its peers, up 17%, and we see Realty Income down significantly lower at 5.77%. So over the last 5 years, ADC has been a better play. Now, what are the institutions doing? Well, 98% institutional ownership, 1.19 billion worth of sales by these institutions over the last 12 months, but we do see a slightly lower amount of buying at 904 million. So overall, institutions are selling more a little bit or marginally than they are buying. We see Q3, however, the latest quarter with more buying than selling, and the 2 quarters in 2023 with the opposite of more selling. So institutions over the last year have been selling them more, but in Q3 we do see in fact more buying than selling. Now, in terms of their earnings, when we do take a look quarter on quarter, over the last 4 quarters, the trend we have analysed is that they have beat on the revenue every single quarter, but they have missed on the earnings per share. Q3, Q2 of 2023, Q1, and we also see Q4 the exact same story. So they are increasing their revenue higher than what Wall Street analysts are expecting, but they are coming shy on the earnings per share. Now, comparing Q3 23 data to Q3 22, in actual fact, they've increased their top line from the last year comparative quarter. They also increased their bottom line net income, but on the earnings per share and net profit margin, they have come in slightly lower, and they have increased their operating income. So quite mixed comparing to Wall Street analysts and their comparative data, but year on year, they are beating their top line revenue as well as their bottom line net income. Now, dividend safety score 70, it is safe. Market cap of 6 billion, it is a mid-cap company. Now, when we take a look at their key metrics, for those that believe a recession is inbound, they cut their dividend during the 07-09 recession, around negative 14% sales, which was the average growth of companies in the S&P 500. and they did actually underperform the S&P with a negative 67% return versus the S&P's negative 55%. Dividend growth a bit choppy this year, was only 1.6%, which is lower than that 4% I do essentially advocate on the channel to keep in line with inflation. The last 5 years, however, 7% has been more positive. I would like to see next year be at least at a minimum in line with inflation, and over the last 20 years fairly poor at 2%. They are increasing their dividends, and they have been over the last 10 years. Now, in terms of dividend yield theory, it states a company is undervalued when the current yield sits above the 5-year average. So we have a sign of severe undervaluation here, with the yield sitting at 5.03% versus the 5-year average. But as always, do bear in mind we're not looking at any of these models in isolation, and we will draw our conclusions towards the end of the episode. Forward P to AFFO 14.5 versus the 5-year average, another sign of undervaluation, and we see the P to FFO slightly lower at 13.7 versus Agree Realty's at 14.5. Now, typically on the channel, we focus on the free cash flow payout, but for REITs, it is more volatile. So we focus on the adjusted funds from operation, looking below 90%. Consistency is what I love to see in all of my investments, and they are consistently having a payout around 75, the mid-70s, so to speak. 2022 and 2023 expected to be 73%, as well as 2024. So that is quite positive to see the consistency, and the payout is at a very good rate. On top of that, adjusted funds from operation, very, very strong, very healthy, consistently increasing, nearly 2 timesing it over the last 10 years from 213 to 383, and it is expected to go even higher in 2023. Now, in terms of the sales growth, very, very strong. 5 to 10% is a minimum, but we see their sales growth very, very strong in the mid-20s consistently. Something that is very rare to see even in the REIT industry. If you go and look at Realty Income, they don't grow as consistently and as largely as Agree Realty, as well as when you take a look at their payout and FFO per share. Total sales, so numerically, how does that look? 10x their top line over the last 10 years, 43.5 million to 430 million, and expected to grow again. So that is incredible. But let's also focus on the negatives. They are a REIT. They do issue a lot of shares. Your position is diluted. It is essentially a very common theme. And we can see the reason they do this is effectively to fund property acquisitions, as they retain a little of that in generated cash flow after paying out dividends. And this is one company that I do have to say does dilute your position a bit quicker than others. So do check out other REITs on our channel if you want to compare. ROIC 3 to 5% is what we focus on for REITs in terms of management effectively allocating their capital. I would like to see this go back up to the 4 to 5% we've seen at the back end of the last 10 years, but I can accept 3% as a very, very minimum. Operating margin consistently around the 50%. It does look like it's starting to decrease, so that is something I would keep an eye out on, but around 50% is fairly positive for this business. Net debt to EBITDA, remember this is the strength of the company's balance sheet as well as their dividend safety. EBITDA for earnings before interest, tax, depreciation, amortization. And below 5.5 is our preference for REITs. 5.5, this is effectively the number of years it would take the company to pay off all of their debt net of cash on hand. 2022, 5.56, right on the line. 2023 expected to be lower, and 2024 even lower. So that is positive, does show that that dividend is very safe. They do have a decent balance sheet, and it is expected to come down, which is a positive sign for Agree Realty Corporation. Now we jump into the valuation model, and as always, if you're enjoying the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop, and click on that pinned comment below so you can grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio. The first model that we use when we analyze stocks is Graham's valuation. For REITs, this isn't applicable, but what we typically do is have their stock ticker symbol, earnings per share, growth rate per analyst estimates, and that current yield on AAA corporate bond to get to the intrinsic value. So the first model we're using, the REITs multiple valuation model, companies that we analyze, same sector size. We have their P to AFFO multiple and the average to get a stock price for ADC at $62. Now, when we compare that to the current trading price, there is some upside to the current trading price at around 5 to 10%, but it is within that 52-week range. So some small signs of undervaluation based on that model. And as always, remember, we never look at any model in isolation, and we will draw conclusions towards the end. Yearly dividends we have here, we see the increase. Now, it did start off quite nice above inflation. It has started to come down on average at 3.27%. Forward looking, I've gone for 3.75, but as always, when you grab a copy of the model below, you can play around with these numbers depending on your investment thesis. This gives a DDM price of $71, and as we can see here, pretty much near that 52-week high, showing some strong signs of undervaluation in the current market for ADC. We then move on to the third model, which would typically be the discounted cash flow model. However, for REITs, and this one in particular, it is very volatile. We see a lot of negative every year, so that isn't applicable to use for our intrinsic value calculation. So for today's episode of ADC, it is purely the average of these two models, which comes to around $67. Now, current price sitting at $59. Margin of safety, as always, 10% is what we use if we believe it has a wide moat, strong financial metrics, good forward-looking data. But for this REIT, with the macroeconomic conditions, the increasing interest rates, we don't know when they will be cut, I would personally go for a higher margin of safety. Now, before we run through the margin of safety, just to let you know, this isn't one I hold in my portfolio currently, but it's definitely one that I will be adding in the future when it does come to a reasonable margin of safety. For those looking at 15%, it would be a buy at around $56. So right now, you are getting between a 10 to 15% margin of safety of the company. Those looking at 20%, around $53. And if we take a look, that is pretty much at that 52-week low price. And it is at a price that I will probably start to add and dollar cost average in at around $53, $54. So it's not too far off where I would look to add a position and start to dollar cost average in at around a 20% margin of safety. In terms of Wall Street, well, they also believe some upside to the current trading price, pretty much in line with our intrinsic value at $65. So they do see around 10% upside to the current, 10 to 15% current upside to the value. So right now you are locking in my opinion, between a 10% to a 15% margin of safety, but it does depend on what you are looking for. As always, let me know your thoughts in the comments below. Is this one you're looking to add? Is it one maybe you've held on before but sold? And at what price are you looking to add or have been adding this quality company? As always, do click on that pinned comment below so you can grab a copy of the intrinsic value calculator to get to the acceptable buy price of companies in your own portfolio or on your watch list. As always, smash that like button if you've enjoyed this REIT episode. Let me know if you'd like to see more REITs. Do also smash the subscribe and bell button if you want to be continually notified of these videos as they drop. And as always, have a great day and catch you all in the next episode. Take care for now.